Public account's having a great day. We're up $57,000 in the public account here today. A lot of big movers in that one. Tesla MySL's up $23,000 today. Elf's up $11,000 today. Meta's up $11,000 today. Palantir's up $4,500. Even flipping Flapjack and PayPal's up. Do you know how much the market has to be like in a good state for PayPal stock to go up? This stock never goes up for me. I mean, holy smokes, this ain't no dang joke. So nonetheless, you should be making some money out there today. Even the dividend portfolio is actually up. This account's been just trash for the last several months now at this point in time. This portfolio did very well last year when the market was getting hit heavy and no one wanted to grow stocks, but now the dividend portfolio just like has been horrible, but even this one's eking out some green today. Nvidia's making another big run. I can't wait till all the people that say Nvidia's overvalued are paying $1,000+ for that share and they're jumping over themselves. That's going to be quite an entertaining thing. I'm just waiting on that whole situation. Okay, so what's going on here? Why are stocks flying high today when we have a situation where it looked like bad news came out? Okay, so let me explain this and kind of get into this in detail here. Alrighty, so first up, the reason the stocks are going up is treasuries are going down, okay, especially on the long end, which is kind of, let's just think about it here. These are all going down here today. And the market's been pretty simple recently. If treasuries, or especially the long end, if treasuries are going down, then stocks are going up, and vice versa. If the long end's going up, stocks are going down. It's been a pretty simple market here recently. But where this gets really fascinating, right, is treasury yields drop after new data shows consumer confidence waning, right? I mean, if consumer confidence is waning, you would automatically assume, well, shoot, man, that must mean recession risk goes up. That must mean, a company earnings going to be as strong. It would usually cause the market to go down and be worried, right? The conference board said its consumer confidence index came out at 106. That was below the Dow Jones estimate of 116. So we're not talking about a small miss. We're talking about a massive, monumental miss in consumer confidence from this particular index, right? The conference board also said average inflation expectations increase for the next 12 months, which is really from like the consumer level. That doesn't mean it's from the Wall Street level. This is more from the consumer level, okay? Pressuring overall confidence, while the short-term outlook for income, business, and labor market conditions declined, okay? So basically people are expecting the short-term outlook for their income, their business, if they own one, and labor market conditions to decline. Traders also poured through new data on U.S. job openings. The latest job openings and labor turnover survey showed open listings declined to 8.8 million from 9.5 million. They also reached their lowest level since March 2021. Okay, so now it looks like we're starting to see some weakness in the jobs market, right? Now this is fascinating because in most markets, like you would think, okay, this is like potential bad news. Like, why would stocks be flying in the face of this situation, right? Well, normal market, bad economic news equals the market down, right? And good economic news makes the market go up. And this is most of the market. I mean, certainly the first several years of me getting in the stock market, this was definitely how the market approached things, right? Because, I mean, I got started in 08 and into 09, right? And at that time, it was just seemed like bad economic news on bad economic news. And then when we started like bottom out things a little bit and it looked like we were getting some glimmers of hope, the market would go up on these like glimmers of hope of like things are going to get a little better, and it looks like we're going to see stabilization in the banking system and see stabilization in the unemployment rate and those sorts of things, and we're kind of bottoming out, and we should slowly start to get better, right? But this is so opposite of the market we're in right now. We're in what's called a high inflation market. In a high inflation market, it's complete opposite. If you get really good economic news, the market's going down, because if the thought process is, if the economy's too strong, really good, right? Well, that means we haven't killed down inflation. If you haven't killed down inflation, that means Fed funds futures and Fed funds rates are going to go higher. If those go higher, it's going to affect all the treasuries. It's going to affect all interest rates in general, which means car loans are going to get higher, which means mortgage rates are going to go higher. The whole dang thing's going to go higher, which means you're likely setting yourself up for a deeper, darker, potential hard landing type recession scenario the more and more you push interest rates. The more you push interest rates higher, the more you're likely going to have systemic problems in the banking system, the more likely you're likely going to have a credit crunch, and the more likely you're going to have a devastated economy at some point down the road when those Fed lags catch up, right? So we're in just a complete opposite market right now where it doesn't want this situation, right? Palantir, PLTR Technologies, we're up 64% on this one in the public count. All these are as far as a percentage basis, up a little less than $32,000 on Palantir right now. Palantir's market cap's about $31 billion on this company right now. And in terms of my base case for Palantir, so here's where things get interesting, right? For Palantir, based upon the net income growth, they should be able to pound out over the coming years, which I think 75% a year is pretty realistic. Remember, this company's at infant stage profitability. Like if you're a company that's been profitable for 5, 10, 15 years, 75% average for the next 5 years is ridiculous. For Palantir, it's not ridiculous at all. So basically, I have them doing just under $5 billion of revenue in 2027. I've been doing about 1.1, maybe 1.2 as far as net income goes. And with a company with the gross margins Palantir has, I think they can definitely hit that number. I think it's very realistic. Now, this is where things get interesting, right? At a 50 PE, they'd be a $58 billion market cap, right? Well, the market cap right now is 31, so even at a 50 PE, it's not even a double up, right? But what do you throw for a PE on a company that's growing 20% plus a year top line and growing 70% plus a year bottom line, right? I think a 50 is pretty fair. I think you could actually command probably a lot higher than a 50, probably a 60, 70, or 80, right? I only run my projections up to 50 because I never want to price in like a 60, 70, 80 PE scenario, 90, 100. But I can tell you, it doesn't really make sense to price a stock at a 30 PE or 40 PE when you're growing your net income 70% plus a year over the last many years, right? So that's where things get really interesting with Palantir. I really like Palantir a lot as a business model. I feel like it's a very attractive risk reward. I think it's a very misunderstood stock in terms of their business model and in terms of valuation. Because some people say it's ridiculous to have a 60, 70, 80 PE on it. Well, you just don't understand growth investing. That's, if you are a great growth company, you can command those valuations all day. And great growth companies, guess what? They always trade rich. Amazon's always traded rich. Since the first time I looked into Amazon, like 2010, 11, Amazon traded rich. Tesla's always traded rich. Palantir's always traded rich. These stocks always will trade rich. Great growth companies that have great 5, 10, 15, 20-year growth, exciting opportunities they're going after. These companies are always going to trade rich. And it's just up to you if you want to pay up for it or not, right? Some people are willing and other people are not. And if you're not, you'll just be left on the side of the road. That's just the way it works in regards to stocks, okay? I feel like it's been almost a year that people have been talking about, oh, this is the last rate hike. Oh, this is the last one. Like, it's felt like that for nearly a year, and certainly almost this entire year, right? The Fed's done. And then after Silicon Valley Bank, then it really felt like after the whole regional bank situation, it really felt like the Fed's got to be done. This has got to be it. And then they kept going. And so, we've been thinking they're done for like 6 months, 9 months at least now, if not 12 months, and they just go. So that's the problem. You don't know if they're really done. They're not going to announce it either.